one example I use for compounding often is the issue of a penny doubled every day for a month for 30 periods. And that turns into $10.8 million. One penny turns into 10.8 million in 30 periods, 31 days. That's the effect of compounding. And so when we're looking for businesses that do this, we want businesses that can reinvest their free cash flow back in the business to continue to earn the above average rates of return on that capital, and therefore compound the owner's capital.
Above average rates of return, what does that mean these days?
It's important. The average return in common stocks for nearly 100 years in this country is around 10%.
Right.
Whether it's 9 or 11 is of no consequence to us.
And that's dividends reinvested?
That's total return,
right,
absolutely.
Total return.
And so in our case, we look to be able to return above average returns, and we've done so for a very long time. And depending on which vehicle we're talking about, it's a different level, but substantially above that average return.
Chuck, why don't you favor dividends as much as many of the other great investors that I talk to do?
Well, we said at the outset that our goal is to compound our capital, and there is no free lunch. A management has 3 or 4 choices to do with all the free cash they generate. They can pay dividends, they can buy back stock, they can invest in their own business, or they can acquire other businesses. And so in order to compound our capital, the most efficient way to do that is to invest in their own business or another business where they earn above average rates of return. If they pay a dividend, they no longer have that capital to do that. And so it's marginally less efficient way for us to compound our capital.
And you also not only wanted to deliver above average returns, you also want to deliver above average returns with less than market risk.
Correct.
Which you have done over time. So
Correct.
What's the secret to delivering below market risk?
Well, so it's not a secret. It's really quite intuitive and straightforward. And that is the businesses which we own in the portfolio have more growth, higher returns on capital, stronger balance sheets, and frequently valuations which are below market. So just on the face, they have a below market average risk.
And yet, when I look at the Akre focused fund,
right.
for instance, it's very focused. That is not a misnomer.
Right.
In fact, you have about 30 holdings.
Correct.
And the top 10 are about 2/3 of the portfolio.
Correct.
So,
and the bottom 10 are less than 10%.
And some of them you've held for 20 some odd years through great markets and terrible markets.
Right.
As stock prices go up and the valuations are not as attractive, isn't that a high risk proposition?
Not necessarily. The requirements for a great business for us have really 3 components. The first is we spend a lot of time trying to understand what's causing this above average return to occur. Is it getting better or worse? The second thing we look for are the people who run the business, and not only do we want to have great business managers, but we want to see to it that they treat public shareholders as partners, even as they don't know them. And then lastly, we look to see if there's a great history of reinvestment of the free cash flow, as well as a significant opportunity to reinvest free cash flow and earn above average rates of return. Those are the characteristics of the businesses. None of those things ever behave in a constant fashion. Business models get better, they get worse with time. People's behavior sometimes changes modestly. The ability to reinvest or the results from a reinvestment will vary from time to time. And so we make a judgment about which ones are real keepers.
So given the fact that there are thousands of companies to
Right.
choose from,
Right.
So why is it so hard to find companies that have those 3 characteristics?
Well, the first 2 things, the business model and the people, business models change over a period of time. And so they will behave differently in different environments, and you watch that. People's behavior will change over a period of time. Sometimes, in my business, I keep saying to myself, actually, I'm getting better with age, and I hope that's true. The outcomes would reflect that.
Let's use an example. Markel,
Right.
a property casualty insurer. You've owned it for over 20 years?
Over 20 years, right.
And you've stuck with it throughout those 20 years?
I have, and in 2013, the growth in book value per share was 17 or 18%. It's 18%, I think, and over the last 5 years, 17%. Over the last 20 years, it's probably about 14%. And if you went back 10 years ago, it might have been above 20%. And so it will go up and down with all kinds of issues. The level of interest rates in our country are at a 30-year low, and so with a business that's leveraged in their investment portfolio, that makes a difference. Pricing in the property casualty insurance business was negative for 7 years or 8 years, only began to get better about a year and a half ago. So during that last 10 years, there's been one period where the growth in book value per share fell below 10%, but it did not cause us to sell the security because, as I say, in 2013 it was back at 18%. And to have that kind of economic growth in real economic value per share in what I'd call a 0% interest rate market is a Herculean experience. I mean, it's wonderful.
So the returns of the company are phenomenal as far as their business is concerned. What about the stock price?
Well, the stock price has kind of reflected what's going on with the growth in book value per share. And today, we look at these things differently than much of Wall Street, much of the sell side. And in 2013, the growth in book value per share was over $70 a share. I don't recall right offhand, but maybe in mid-70s. And it was most of, certainly all of 2013, the stock price was in the $500 range. Today, it's in the $620 range, something like that. That is still less than 10 times the real economic earnings of last year. The change in book value per share is, in fact, the real economic earnings. So it's still selling for less than 10 times, in our judgment, the way we look at it.
Tell me what you look for in an underlying business.
Well, American businesses probably have single-digit net margins on average. And the returns on equity, returns on the owner's capital, as I suggested, are probably in the low teens. So if we find a business, as we're looking around, that has returns which are significantly greater than that, that causes us to get curious about, well, why is that occurring? And so the simple reasons would be they have patent, or they have the absence of competition for one reason or another.
That's the moat.
Right, that's the moat, the frequent phrase that's used.
That Warren Buffett and
right, and
Ben
sometimes in a business we say, well, we don't know precisely why they're able to do it. This is what we think. And that's okay too. We've learned to get comfortable with that. And
not being quite sure, but
right,
you just know they're doing it.
This is what our hunch is. Management's, if it's something that's really a secret sauce, the managements are unlikely to share it directly with us because it invites competition. And if you have a business with very high returns, it will naturally invite competition. Everybody wants to get something that's got better returns than they have. And so, that's how we go about it. And we spend a lot of time trying to study other companies in that line of business or other businesses that are related and make our judgments that way.
Can you give me another example? I'm looking at your top 10 holdings, yeah. Colfax, Moody's, Mastercard, American Tower, Dollar Tree, Visa.
So some of them are quite easy to talk about. American Tower, for example. They are essentially the largest worldwide in the business of erecting towers in which support antenna for wireless communications.
Big, growing business globally.
Right, and so it's a vertical business. The model is more towers, more tenants per tower, and more rent per tenant. And on the last item, their contracts with the carriers typically have escalators, annual escalators built into the contract. So every year they're going to get 3 or 4% more for that same service. In addition to that, as we've gone from what they call 1G to 2G to 3G to 4G and so on in our handheld sets and stuff, each of those requires actually a denser tower network because they require a greater level of complication, as it were, in the antenna, that sort of stuff. And so each of those greater density requirements requires more towers and sometimes alterations of the antennas on the towers and that sort of stuff. And each is a profit opportunity for American Tower. So it's a very protected business. And then in the last half a dozen or more years, they've been growing extensively outside the U.S. and are in 11 different countries as well as the U.S. And so, very protected. You can see why they get high returns on their assets. On the other hand, if you take business like Mastercard or Visa, it's much more difficult to figure out exactly why they have such high returns on the capital, and the returns are enormous. They are unable to invest in other businesses that have returns that are as high as theirs. So
what a problem to have.
What a problem to have. And so they still have to do something with the enormous amount of cash they generate. And what they've done is they've instituted a small dividend that they grow. They've instituted some share buybacks of the last couple of years where they're buying back billions of dollars of stock, but they still end up with lots of extra cash. And that's a little bit of a dilemma. It makes the compounding a little bit more difficult because they're not reinvesting. So they buy small businesses that help them with advances in mobile technology or whatever else. That's mobile payments, all of those things. But they cannot make large investments that in businesses which have those high returns.
It sounds like, therefore, their sustainable model years in the future might be more difficult than it is than for an American Tower.
It might be, but there's a ubiquity of acceptance of a Mastercard or a Visa card around the world. It continues to grow, and their business model is such that they get paid not only on each transaction, but they get paid on the amount of currency in each transaction. So it's really a wonderful inflation hedge. That is, if currencies get devalued and the dollars involved in a transaction go up, they get more money out of it, that sort of stuff. So it's a really fascinating business model.
You also have, I think, what you call your Workbench companies.
Right.
They're almost like workouts as far as you're concerned. Could you share one of those companies with us?
Colfax was one of those, and it's our largest holding these days, but we started with it in a very small piece, and we were attracted to it for a number of reasons, including what their business plan and model was.
Which is?
They acquire other industrial companies, and through a technique of their own that is based on a Japanese Toyota manufacturing model of continuous improvement, they rationalize these businesses dramatically, and so they source and buy underperforming companies and buy them and improve them and dramatically increase the rates of return.
Do they then sell them, spin them off?
No, they don't. They keep them going for the most part. And the company was founded by Mitch and Stephen Rails, who had also founded over 30 years ago a company called Danaher, where in Danaher they compounded the shareholders' capital at 20% a year for 30 years. I mean, and so we're attracted to that. We're attracted to that way of thinking. They're both significant shareholders and are behind this business. And so in one sense, it's sort of, we thought maybe it's a Danaher redux. And we got started as a small company, and then we went to visit them, and we've been to visit them again and so on, and watch how they've performed with their acquisitions and see how things are going. So that's an example.
Tell me what you look for in management.
You want to find management that, of course, is terrific at managing the business, and presumably they've demonstrated that by the time we get involved. We're very interested in how they think about lots of things. We ask them often, how do you measure your success at this company? By what means? By what? And so we listen to what they have to say and make our own judgments about that. And
what are the kinds of answers that
you
like?
Sometimes you get answers such as, well, if the stock price goes up, and sometimes you find CEOs that have screens on their desk. They're watching the stock price all day long, and that's not a characteristic that we find particularly attractive.
Because you don't care about the short-term
right,
stock performance?
And I would say our quick judgment would be their eyes on the wrong thing. That's our own parochial view, and we're interested in hearing how they discuss the reinvestment of the free cash flow they generate, and how they discuss the arrangement of their balance sheet, and whether they use debt capital and so on, and how much they use, why they, all of these kinds of issues are very important in helping us with our judgment. At the end of the day, if this business could be quantified, I wouldn't have a job. People would just punch a button on a computer and it would do all the investing for them. And
lots of people are doing that.
Indeed, and in fact, some of them do it very well, using very sophisticated mathematics. But that's not what we do. They're trading against prices in the market, and using information that comes to them in their models to do that. And what we are is we're investors in businesses, and we're trying to identify those unique businesses with very high returns, because at the end of the day, the core of our thought process says that our return in an asset will approximate that return on the owner's capital that the business generates.
How many managers are there out there that can afford to think the way you think, to think long term?
I don't think any of them are striving to think the way we think. They'll get to their own conclusion about how to operate the business, and many of our businesses have shareholder support in the way they go about it. They've attracted the kinds of shareholders that they deserve, a line that Warren Buffett has used for many years, and so by the way they discuss their business and the way they discuss their outlook and their operations helps lead certain kinds of investors to them, and so many of the businesses we own have attracted shareholders that are sympathetic with the way they run the business, at least.
Why is it so difficult to identify a good investor, and what's your definition of a good investor?
Well, at the end of the day, it ends up having to do with outcomes, and outcomes relative to goals. And so the issue then comes down to, is there anything that you can do or understand that'll help you predict whether this manager or that manager is going to have an outcome that's coincident with what your goal was? Sometimes they'll do that even when the results might have made you uncomfortable, but nonetheless they still met your goal. For example, we went through that period in 2008 and early 2009, which felt terrible. And the stock market had very negative returns, as you remember. Mm-hmm. And people who understood, for example, what we were about, and were able to not worry about the balance of their account at a period of time, have done wonderfully as a result of sticking with the program. We struggle with trying to make sure that our clients understand what our approach is, and we work very hard to try to get them to understand it.
One investment for a long-term diversified portfolio, we ask every guest, what would it be? What would you have us own in a long-term diversified portfolio?
Well, I think we talked about Markel earlier. Sort of everything about the business is terrific. Today they have a $17.5 billion investment portfolio on just less than 14 million shares outstanding. So they have enormous leverage to the opportunity of rising rates. Rates have been declining for 32 or 3 years. Someday they won't decline, and so that kind of leverage on rising rates will be very important. Number two, pricing in the property casualty business began to strengthen about 1.5 years ago after 7 ugly years, and maybe it's stable or improves a little bit. 3, they made an acquisition last year that doubled the size of their gross written premium. 4, they have taken an attitude that is slightly more opportunistic about managing their balance sheet. And then 5, they have a division in the company called Markel Ventures that is growing a stream of income away from the insurance business, a la Berkshire Hathaway. And so you can buy it at less than 10 times our notion of economic earnings today and have a good shot that it can compound our capital on average probably in the mid-teens for the duration.